Hello traders, I hope you are doing fine. So by the end of this video, you'll be able to analyze and take entries using a bullish entry model in smart money concept. To apply this model, you need to make sure that the pair that you're looking at is in an uptrend. And to determine that, you will have to see a series of higher highs and higher lows, which will be accompanied by break-off structures. So as we can see here, this pair printed a high from this sketch. We can see that the pair printed a high and a higher low, and we had a break-off structure which surpassed the previous high to make a new higher high. And there is also a higher low here and another break-off structure to make a higher high. So if you look at this market, we can see that it is bullish. So as you might know already that when buying in an uptrend, you need to take an entry at the lowest possible point, which we can call a higher low, as I've demonstrated earlier. So this particular model focuses on predicting um, uh, the point which is most likely to be a higher low, so that we can enter and push price up to make another break-off structure and ultimately a new higher high. So another important thing that you need to look at is volume. I will explain about volume in my other videos that I'll be posting. But for now, you just need to know that um, volume is just in confirmation that traders, in particular buyers, are now in the market. So in this case, you will need to see um, larger volumes, larger candles piling up and giving us a break-off structure like this one. So usually those candles leave a gap which they call a fair value gap. So usually you can see it will be right here, the fair value gap. So this fair value gap, I will explain about the fair value gap and volume in my other videos. But if you see those larger candles piling up and giving us a new break-off structure, you can know that buyers are now in the market and the market is ready to go up. So volume is an important thing that we will need to identify before we can apply this model. So once we have confirmed a break-off structure, which is accompanied with volume, which we can see with the fair value gap, we will need to identify an order block, which we will put our buy limit, or where we will enter the market. So an order block is taken or identified from the last candle that was printed before an impulse move. So in this case, this will be our impulse move. So the last candle that will be printed before we can see this move, that will be our order block. So let me explain another thing that we have to be careful of. Remember, the market doesn't move smoothly. It always makes situations that will trick you into entering a trade prematurely. There is this thing that they call liquidity trip or inducement that I labeled here. So that point looks like a solid buying area, but it will be a trap, because in other situations you can see that there will be volume and there will be also an order block that will be valid in your eyes, but actually that will be a trap. Those will be the institutional traders that will be trying to take your money. So you will need to be aware of this. So to avoid getting trapped, always make sure that price mitigated all order blocks, all previous order blocks that were with volume before you can decide to take that buy. In this case, price left this area unmitigated, meaning that it didn't tap in before we got to this move. it didn't tap into the order block. So that means this area above here will be a trap. So usually price gets to that area and it will fake a move upwards, then it will sweep you out. So make sure that this area below will be mitigated before you can try to take a buy here. That's how you can avoid a liquidity trap. So after all this, we now take our buy. We'll set our buy limit here. Our stop loss will be just below that order block, and we'll be targeting this previous high. So that's our entry model. So let's just go into look at this in a real market situation. So I'll be analyzing GBP USD. So as you can see here, price was making break of structures going up. So let me start by marking this area. This was a break of structure, and we had another break of structure here. So usually when I'm analyzing this pairs, I start from the daily time frame. I come to the H4, then this H1. But on this one, I started on H1. But just to remind you, this pair was bullish on day. It was also bullish on H4. So now we want to see the area, which is most likely to be the entry area that we can set our buy limit. So today is Sunday, and the market will open on Monday tomorrow. So after we have analyzed, we will wait for the price to play out on Monday so that we can see if the trade will move away. So after this break of structure, the first one here, you can see that there was volume here. These are the larger candles that I was talking about earlier. But we take an order block from the last candle that was printed before the upward movement. So this was the candle, and you can see that price tapped in that area, and it continued to go up to give another break of structure here. So this break of structure, we would like to see where the origin of this break of structure is. So as we can see, price was coming from this area, reminding you of that part that I talked about, where you don't have to take the order blocks, leaving an area with another order block, a previous area with another order block that was not mitigated. So this was the last area that was left unmitigated after we have mitigated this area. So we expect that price will come down to this area, and this point here will be our liquidity trap. So we will wait for GBP USD. We'll wait for it right here. So our entry will be set here, targeting this high, and our stop loss will be here, about 20 pips. So this is the entry on GBP USD. So maybe I can do another one so that you can see how this model works. So let me try NZD JPY. Okay, so this was our last break of structure going down, and the market changed character here. So I'll do a video to explain about market structure. But as you can see here, price broke below this previous lower high and made another low, but then it failed to break this lower low. So this previous point here will now be our new high. So we broke above this high and now we are bullish. So after changing character, we can see that price left this area unmitigated. It didn't come back to tap in that area, and we started to have another series of higher highs going up. Sorry, that will be a break of structure, not a change of character. And you can see that from this area, there's those large candles to confirm that buyers entered the market in that area. And now we want to look for an area which can be our trap, because that's the most important thing. If you cannot identify a liquidity trap, then you always lose in the market. So we can see that this point here will be where the market will be trying to trick you. So when the market enters this level, you have to wait. You have to wait so that it can come down to this area. So this will be our entry area. We'll set our buy limit at this area here, targeting this high, and our stop loss will be just below this area, and I think it will be around 25 pips. So this is how we can apply our bullish entry model with smart money concept, and I'll be doing more videos like this, so don't forget to like and subscribe to my channel so that you can have more insights about the market. Thank you.